Good morning. Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is titled SEC Amends Requirements for Statistical Disclosures for Bank and Savings and Loan Registrants, formerly Guide 3. My name is Pinedo. I'm a partner in Mayor Brown's New York office and the co-leader of the Global Capital Markets practice. I focus on securities and derivatives work representing issuers, investment banks, financial intermediaries, and other participants in financing transactions, including public and private offerings of equity, equity-linked, and debt securities, as well as structured notes and hybrid and other structured products. A couple of housekeeping items before we get going. As regular listeners of our series know, today's call is being recorded. We will be sending an audio link to all participants in case you'd like to listen to the teleconference again or you'd like to share it with colleagues. In addition, the recording is also going to be made available as a podcast on your preferred podcast platform. We will not have a Q&A session, but we're happy to take your questions on today's topic. Please email any questions to gfm@mayorbrown.com and we'll respond promptly. You'll see the email information as well on your invitation email. Joining me for today's presentation is my partner, Jerry Marlatt. Jerry is a partner in our New York office as well and a member of the corporate and securities practice. Jerry represents issuers, underwriters, and placement agents in public and private offerings of debt, covered bonds, surplus notes, securities of structured investment, and specialized operating vehicles and securities repackaging. With those brief introductions, we'll go ahead and get started with today's discussion. Most bank and financial institution issuers are familiar with Industry Guide 3. The Securities and Exchange Commission's staff in the Division of Corporation Finance has had in place for quite a long time a number of industry guides. These industry guides are intended to set out the type of information that registrants should bear in mind in connection with preparing both 1933 Act and 1934 Act filings that then undergo review by staff members within the SEC's Division of Corporation Finance. So historically, these guides have not been formalized as commission rules. Nonetheless, Guide 3, which has been around for many, many years, has guided the types of disclosures that financial institutions provide in both their SEC offering documents, their 34 Act periodic reports, and also largely in their 144A offering documents. So this process of undergoing or modernizing the industry guides has been going on for several years now and is part of the Securities and Exchange Commission's Disclosure Effectiveness Initiative. For a number of years, in response to the fact that there has been a significant decline in the number of U.S. public companies, the Securities and Exchange Commission has embarked on this effort, the Disclosure Effectiveness Initiative, which has as its goal making required disclosures by SEC registrants simpler, more streamlined, modernizing the disclosure requirements, eliminating repetitive requirements or requirements that may be obsolete, and also eliminating any requirements for disclosures that now, through the passage of time, have been incorporated as a result of U.S. GAAP or IFRS standards into the notes to financial statements. Several years ago, as part of its Disclosure Effectiveness Initiative, the staff of the SEC requested comment on Guide 3. After that concept release, a little more than a year ago, in September of 2019, the Securities and Exchange Commission proposed rules that were designed to update the disclosure requirements that comprised Guide 3. What the SEC has done with these final rules that have just been adopted is consistent with its disclosure effectiveness initiative to eliminate Guide 3 as a separate standalone industry guide, to incorporate streamlined disclosure requirements in a new separate portion of Regulation SK, which is Subpart 1400 of Regulation SK, and make various substantive changes. So the new amendments, which are now part of Subpart 1400 of Regulation SK, take on the effective being commission rules and will apply to banks and savings and loan companies. There are a number of things that remain substantially the same as Guide 3. For example, Subpart 1400 sets out the disclosure requirements, but it doesn't specifically require or dictate where an SEC registrant has to include the particular disclosures. As we've seen from practice, most banks and savings and loan institutions tend to include the Guide 3 information in the Management's Discussion and Analysis section in MD&A, and to a lesser extent perhaps in the business section of their filings. But new Subpart 1400 retains that flexibility of letting registrants and their counsel decide where to incorporate the materials. This allows for the greatest possible flexibility. The final rules also don't require that a registrant present any of the new Subpart 1400 data in machine-readable format. So that's a welcome step. As I noted at the outset, Guide 3 has always been understood to apply to banks and savings and loan registrants, although a lot of the information that was historically solicited by Guide 3 and that is required by Subpart 1400 relates to activities that involve extensions of credit and other borrowings. And it's conceivable that there may be entities that are not banks or savings and loan registrants that engage, at least to some extent, in the types of activities that would be covered with existing Guide 3 or Subpart 1400. In order to promote additional certainty, the final rules make clear that Subpart 1400 of Reg SK only applies to banks and savings and loan registrants. So that provides a little bit of clarity and makes clear that non-bank financial institutions are not required to comply with these disclosure requirements, although, of course, if the information is material, they would furnish some portion of the same type of material, albeit not necessarily in the same format. Subpart 1400, like Guide 3, is applicable both to domestic and to foreign issuers, as well as to issuers that file registration offering circulars under Regulation A. There had been some concerns raised that foreign issuers that are IFRS filers would be subject to different requirements or might face challenges in connection with providing the disclosures that had been incorporated in the Guide 3 proposing release. However, what became clear during the comment process was that there were very few instances noted by any commenters where the required disclosures would pose a challenge for foreign registrants. In fact, many of the streamlined rules take into account the requirements of IFRS to provide certain information in the notes to financials. Now, that said, even though there weren't any instances of hardship that were noted by commenters, the Commission points out in the adopting release that both Securities Act Rule 409 and Exchange Act Rule 12b-21 remain available to both domestic and foreign registrants in order to seek relief to the extent that there are disclosures required that would result in significant hardship for the registrants. In terms of the reporting periods that are covered by the rules, so this is an important change from Guide 3, which requires that information be presented generally for 5 years. Subpart 1400 defines the term reported period for purposes of the disclosures to be the period of each annual period for which the rules require the registrant to provide financial statements. So essentially, it aligns the financial statement requirement with the disclosure requirement. Generally, under SEC rules, a registrant is required to provide 2 years of balance sheet data and 3 years of income statement data. There are special rules for smaller reporting companies and for emerging growth companies. So the disclosure requirements under subpart 1400 essentially just follow along with the disclosure requirements for the financial statements or the periods required by the financial statements. In addition, in contrast to the proposing rules that would have required that registrants provide certain credit ratio disclosures for the registrants' prior last 5 fiscal years in an IPO registration statement or in an initial Reg A offering statement, the final rules limit the required credit ratio disclosures that Jerry will talk about in just a little bit to the periods for which financial statements are required. So again, that aligns the disclosure requirements with the financial statement requirements under the SEC rules. So with that bit of background behind us, I'm going to turn things over to Jerry to dive into some of the additional disclosure requirements.
Thank you, Anna. So I'll start with item 1403, which addresses statistical disclosure for a financial institution's investment portfolio. As Anna has said, 1403 streamlines the requirements from item 2B in this case of Guide 3. And under the new disclosure, financial institutions are required to disclose the weighted average yield across a range of maturities of their debt securities that are other than debt securities that are carried at fair value. And the range of maturities are 1 year or less, 1 year to 5 years, 5 years to 10 years, and greater than 10 years. Item 1403 does not codify and did not pick up the requirement from Guide 3 to disclose book value information, maturity analysis of book value, or investments that represented an amount greater than 10% of stockholder equity. As Anna has said, these items that are not codified were not codified because either they overlap with financial statement requirements or overlap with existing SEC rules. In addition to weighted average yield, the registrant must disclose how weighted average yield is calculated. Turning to item 1404, which focuses on a financial institution's loan portfolio. Item 1404 requires the disclosure of loans by maturity in each financial statement category, plus the amount due after 1 year in either at a predetermined rate or at a floating or adjustable rate. And the maturity categories are less than 1 year, 1 year to 5 years, 5 years to 15 years, and greater than 15 years. The last two categories were a breakout in response to comments for a little more granularity. In the proposal, it was simply greater than 5 years. Unlike Category 3, there are no exclusions from the disclosure requirements, and the maturities are to be based on contractual terms. Where there's a rollover policy, that is, where non-contractual extensions or rollovers may occur, disclosure of those loans under item 1404 is required if those loans are included in measuring allowance for loan losses. 1404 does not codify category, that is, types of loan disclosure previously required by item 3, item 3A, loan portfolio risk elements previously required by item 3C, and cross-border outstanding amounts previously required by item 3A. Again, for the reasons that it overlaps with financial statement requirements and SEC rules. Turning next to item 1405, which is the allowance for loan losses. Allowance for loan loss requirements are by financial statement loan categories. And on a consolidated basis, financial institutions should disclose allowance for credit losses compared to total loans, non-accrual loans compared to total loans, and allowance for credit losses compared to non-accrual loans. The fourth category, net charge-offs compared to average loans outstanding for the period, is intended to be done on a disaggregated basis rather than on a consolidated basis. Item 1405 also requires discussion of the factors that drive any material change in these ratios from period to period. 1405 does not codify rolling forward of allowances previously required by item 4A of Guide 3 on the basis that it overlaps with financial statement requirements. There is no new disclosure required as a result of the new credit loss standards. And there was considerable commentary on the proposal in that regard. The Commission's conclusion was that the ratios discussed here are commonly disclosed by banks and by bank holding companies and should continue to be disclosed. Turning to item 1406, which addresses deposits. 1406 is codifying item 5 of Guide 3, and most of the current Guide 3 requirements are codified into 1406 with some revisions. So the categories of disclosure are non-interest-bearing time deposits, interest-bearing time deposits, savings deposits, time deposits, and others. The release also notes that additional categories can be used if a registrant believes that would be more important than the items disclosed above. If material, the registrant should also disclose the ratio of domestic deposits to foreign deposits. The registrant is also required to disclose uninsured deposits, that is, deposits that are not insured by the FDIC, by state insurance, by insurance provided by foreign governments, or other insurance. 1406 also requires disclosure of U.S. time deposits that exceed FDIC or state insurance, or time deposits and time deposits that are uninsured, both U.S. and foreign. These time deposits in excess of insured insurance availability are broken into four categories. The categories are 3 months or less, 3 months to 6 months, 6 months to 12 months, and greater than 12 months. And with respect to the methodology for determining amounts that are uninsured, the release says registrants should use the same methodology that they used in their regulatory disclosure. Turning to what has not been codified, and we've discussed some of that as we've gone through here. Item 6 of Guide 3, they had required 4 specific ratios that are not required under subpart 1400. That is return on assets, return on equity, dividend payout, and equity to asset ratio. The Commission concluded that these ratios were not unique to banks and S&Ls, and if they're material, they should be discussed as part of MD&A. With regard to item 7 of Guide 3, short-term borrowings, generally the requirements of item 7 were not codified, except to the extent they're covered by item 1402 with respect to average balances and average rates. Otherwise, short-term borrowings in the SEC's view are picked up by existing SEC rules and financial statement requirements. And the remainder of the items of item 7 of Guide 3 were also not codified. We've covered most of these, I think. Book value, maturity analysis of book value, investments in excess of 10%. I think we talked about that in connection with item 1403. Lastly, I might say there were some related amendments. First, to Article 9 of Regulation SX to extend coverage to S&Ls and S&L holding companies. And item 9-03 of Regulation SX, item 404 of Regulation SK, and Form 20-F to correct the references from Guide 3 to subpart 1400. Maybe lastly, with respect to practical considerations, the rule will apply to fiscal years ending after December 15th, 2021. And disclosure will not be required in initial registration statements until an initial registration statement is filed containing financial statements for a period on or after December 15th, 2021. The release does note that voluntary compliance is permitted in advance of the requirements. With that, Anna, I'll turn it back to you.
Thanks, Jerry. So thank you to our audience for tuning in for today's session. A couple of reminders. As I mentioned at the outset, you'll receive an email that has a link to the recording for today's call. The recording will also be available as a podcast on your preferred podcast platform. We've written an alert that goes into a fair bit more detail regarding the changes to the subpart 1400, formerly Guide 3, disclosure requirements. So we hope that you consult that as well. And if you have any questions related to today's content, please feel free to email those questions to gfm@mayorbrown.com. Thanks so much for your participation. You may now disconnect.